As Prudential's head of finance, Yanela Frias oversees more than $15 billion in annual retirement income payments to more than 2 million individual and institutional customers. And she empathizes with the struggle for security in retirement in an era when pension plans have largely given way to 401ks.
The challenge is the 401k was always a tax-advantaged savings vehicle. It was never meant to replace the defined benefit plan. And so what we need to do is help individuals understand, yes, you need to save in your 401k plan, but then how do we turn that into protected income, lifetime income?
In this environment, annuities are gaining traction as a solution, with sales booming across the entire industry.
The baby boomers are retiring, and they're really, right now, almost today at that peak age. People at that retirement age need protection from downside in the markets, and so annuities are a great way to get that. And longer term, they're going to need an income replacement.
We have been in the accumulation mode. Now we're hitting peak 65 in the US, but think about Japan as well. We're in the decumulation mode, and people need security of income as they go forward. They need lifetime income.
Are annuities back in vogue and here to stay?
They are, and I think they're here to stay because they're a great vehicle to create that protected income. And one of the good things is that annuities have actually gotten simpler through the cycle, right? So that we went through the period of the guaranteed benefits and the living benefits, and annuities became very complex and expensive, to be fair. With the simplification of the products, less expensive, I think that's what's really brought them back.
Prudential is a major player in another robust retirement market, pension risk transfer. Deal volume has soared in this space, where employers sell their in-house pension plans to insurers, reducing the risk on their books and helping preserve benefits for retirees.
You have organizations that are not insurance companies running an insurance business on their balance sheet when you think about the large organizations and their pension balances. And so what a pension risk transfer transaction does is it transfers the liability and the obligation to an insurance company that's better equipped to really manage that and ensure that those payments are getting to the annuitants. We've done 7 of the largest 10 deals in the U.S., and it's a tremendous opportunity. There's $3 trillion in pension balances in the U.S.
Where do you see the growth in that pension transfer, that pension risk transfer? Are there big opportunities beyond borders?
Yeah, at some point, we think there are pension risk transfer opportunities beyond borders. Today, we participate in the UK space through longevity reinsurance. We've also participated in Netherlands, again, through longevity reinsurance. We think at some point in Japan, that's an opportunity. And in Brazil, we think over time, today we're in life insurance, but over time, the product set will evolve as well.
How do you drive this business forward? You've got a great opportunity. You're sitting into the CFO seat. You can shape this in your own image. What's that going to be?
Well, I think a big part of it is how do we source capital? The reality is there's not enough capital in insurance companies today to meet the need when you think about pension risk transfer, individual annuities. And so one of the things we're thinking about is how do we source capital differently? So that's where third-party capital comes into play. So we have a sponsored entity, Prismic, in Bermuda, which is our way of accessing third-party capital to continue to bring those solutions to the market.